Hi everybody, welcome to the Middle Class Investor. Today is Sunday, July 13th, and we didn't have a video last week. I don't know, with Independence Day holiday, just didn't get around to it. But nothing really happened that we needed to discuss, I suppose, anyway. So what you see on the screen is just it's the rising wedge, the enormous rising wedge that we've been watching for a long time now. If I let me go to a daily chart and zoom in, you can see here that the market has been pushing up against this upper bound and actually has broken out of that. This is what we kind of call a throwover. Although it's kind of been lasting a while. You normally kind of get 1 or 2 days in this throwover, and then that's it. But because it's so large, let's go back. Let's pull it up on a weekly here. You really only have, like, these last 2 weeks. You can see this last week it went down, but 2 weeks ago it popped up above it, and then the following week it jumped right back down. So the question is, what's going to happen here? And of course, there's only one of two options. It either breaks out and goes up from here, or it pulls back down through here. Now, I've talked about the probability of this pattern is pretty high. It's about 2/3 of the time the pattern works out, and it jumps to like 90-something% if it actually breaks out of the pattern. So, and that wouldn't include a breakout to the upside. That's not part of the pattern. That's a failed result, I guess. So the way the pattern works is it's got about a 62% probability of happening, and if you wait till the breakout to the downside, it has a 90-something% probability of happening, of achieving the result, which I've talked about before. But the result, basically, you go back to the width of this wedge down here at the bottom, and you add that to the breakout area. So you're probably talking about down in this area. So that's kind of how it works. In my mind, I'm thinking, it's such a large wedge that it could just be taking a while to resolve itself. If we were looking at a wedge on a daily chart and then I zoomed into an hourly chart, you might see the same kind of battle right here at the top. So I don't know that this is unusual, although I don't have, like most people, I don't have a lot of experience with a rising wedge that's 5 years old. So, but I think, if you look at general market sentiment, and to me this fits the narrative or the story, and that is, when things get really loud, people, you start hearing on the media, oh, this is a new bull market, and this kind of thing, and you have this rising wedge. To me, and there's other pieces of evidence, but to me, those are signs that those are caution signs. Those aren't let's get aggressive signs. The participants in the market follow a herding instinct. So it's kind of like if a bomb went off and everybody ran, whatever direction everybody's running. If you're in the middle of that, you're probably going to start running in the same direction. You don't know where you're going to. You don't know what's causing you to run that way, but everybody's running that way, so you run that way. That's kind of the herding instinct. And just as I said, it's an instinct. It's something below our subconscious that causes us to do this herding thing. And it's a well-known market phenomenon, and it always happens this way. I mean, when everybody gets on one side of the market, that's when the market turns and goes the other way. Same thing with the bottom. When everybody's saying, "Oh, the world's coming to an end, and we're just not going to make it. The market, the stock market, the capitalist system no longer works, and all this kind of stuff." That's when it turns and goes to the upside. So this is just the normal way the markets work. Now, one of the things I have up here is a chart of the VIX. Let me put it up. Let me go up like 5 years as well on here, and you can see that. Well, let me go a little further. You can see that the VIX during the financial crisis got all the way up here to 90, which is super high. I'm not sure, since the VIX has been around, I'm not sure it's ever been higher than that. But the VIX is kind of an oscillator. But really what happens with the VIX is it represents, and this is not exactly right, but this is a kind of a layman's view of it. The VIX represents the willingness or the aggressiveness for which participants are buying out of the money put options for the S&P 500 index. So S&P 500 index options. How aggressively are participants buying those options? And this point right up here, people were buying. They were buying risk premium, if you want to look at it like that, for the market to go down at a very high price. They were paying a very high price for insurance, if you will. So if the market went down, they were going to be whole. So, consequently, down here, market participants aren't willing to pay hardly anything for insurance for when the market goes down. So when the VIX is low, that means that there's a lot of bullishness. When the VIX is high, that means there's a lot of bearishness. Now, you might have heard the saying, when the VIX is low, it's time to go. When the VIX is high, it's time to buy. These are high and low in the VIX those numbers don't really, those words don't really mean anything, because as you can see, the VIX, I've got two lines drawn in here. It kind of bobbed around in this zone for, let's see, from first quarter of 2009 all the way to, the end of 2013, let's say. So that's a pretty long time to be in there. Of course, what did the market do? The market went up. So the VIX is not something you can look at and go, wow, it's time to get out of the market, or wow, it's time to get in the market. But it's just another measure of fear or complacency in the market. And what happens when people start getting complacent, they're not worried about the market selling off. You'll see the VIX down here in this very low area. And of course, you can see the last time it was down at this area was down in here in 2007, end of 2006, beginning of 2007. And of course, right in here, when the VIX got into this area above 15, that's when the panic started to ensue in the market. So it's just something to be aware of. Wanted to put it up just for that reason. Let's look at the interest rate market. This is something we've been looking at for a while here. Let me go back to the weekly chart, and let's do 5 year. We'll zoom in. This is what we're calling the potentially the meaningful low. So let me zoom in just behind that. And you can see if this was the meaningful low, then we made a move off this low, which you got to understand, during this move right in here, there was a lot of fear in the market. Oh gosh, this is it. The bull market in bonds is over, blah, blah, blah. Now, as it's been consolidating and moving in this direction, people are starting to second guess themselves. They're starting to say, oh, maybe this isn't the end of the bull market in bonds. Maybe we're in for another leg down. So in the spirit of that conversation, I went ahead. This is the box we've had on here forever, and you can see the market pulled down. It kind of zigzagged down into this box, and then it bounced. But this is a pretty, this week right here, last week, this big red candle right here, this was a pretty, let's zoom in on that a little bit. this was a pretty significant week right here. I mean, we had a significant week up, kind of like a blow-off top on interest rates, and then boom, they sold it right back off in interest rates, which means the bond market was going up. So, there was like a rash of bullishness in the bond market, or bearishness, and then the following week there was an equally large rash of bullishness, which caused the interest rates to go down. So what I did is I went ahead and marked another box down here for us. And the reason this is way down here, you can see there's no swing in here really. There's a little swing here, and it might pause a little bit, but if it breaks out of this box, it's going down to this area. And this actually could coincide with a rapid sell-off in the market. Something could spook market participants over here in the S&P 500, cause them to sell stocks and run into bonds, which would lower interest rates. And it kind of makes sense given that there's really no other swing until you get to here. So I put a box down here where interest rates would likely fall if we break this low here. So if we break this 2.404% on the 10-year, you're likely going to see interest rates fall down into this 1.6 area. And then we'll just have to wait and see what happens. It could make a new low. It could go past this low that we thought was maybe the first move off the bottom, or it could stop here and turn up. And we'll just have to wait and see what happens. And we can talk about that when that does actually happen. How would you use that information to help you in your investments? Let's look at the euro. The euro, same kind of deal. The euro, it looks like this. Let me zoom in on this. It looks like maybe that this was the move up from here to here, from here to here, and all this back this way. You see it came to a higher low, which normally could be bullish. It's really hard to say, but normally when you come to a higher low like this low and then this low is higher, this move is a lot stronger. And it kind of started off strong, like wow, the euro's going higher, but then it's kind of petered out. So watch this close, but I would say if it breaks this area right here, where I've got this line, we'll put a box there, but if it breaks below this area right here, the euro, I would say the euro is not actually bullish, it's probably bearish, and probably will make a new low below this low. There's a lot of talk in the media about the dollar. Is the dollar going to collapse? Is the dollar going to strengthen? What's going on with the dollar? Well, again, the market tends to kind of fool most of the people most of the time. So is it possible that all this money printing is causing the dollar to lose value? Well, certainly that seems to be the situation if you look at gold. This move right here through gold is basically QE. All this happened during QE. So QE, if you're a long-term gold investor, QE was good for you because you basically, I'm sorry if I said that backwards. If you're bearish on gold, QE is basically good for you because gold lost value. But normally you would think, normally participant would say, well, golly, if there's all this printing in the market, money printing, gold should be going up in value. And that's true, but gold may be telling us a whole different story here. Gold might be telling us that, hey, the dollar's not going to go down in value first. Maybe it goes up in value first. And there's really no way to know that, but that seems to be what gold is telling us, that the dollar is gaining value during this move down right here. And it looks, in this little triangle that I've got drawn on here is what's called a consolidation pattern. So it's a trend continuation pattern. So if this is the trend, which it appears to be, then this is consolidation, and then gold looks like it's going to make another low. And we'll watch for that to happen. But we'll have to, first thing to see is if this upper trend line holds. And if it holds, then we'll look for gold to travel down to this trend line, and it'll either bounce or it'll break through. And if it breaks through it, it's likely to make a new low. So we'll watch for that to happen. The Dow and the Nasdaq, every market, there was some weakness in the Dow and the Russell, but the Nasdaq quickly caught up, as did the Russell. And so now all the markets are at new highs. So there's really nothing out of sync with anything else at this point. So I've got these boxes drawn on the Nasdaq. The Nasdaq could make a new high, and this is probably resistance. You can see support is way down here. So we got, the Nasdaq's at new highs, but if it breaks out of this box, the Nasdaq's going much higher. If it kind of gets stuck in this box and chops around, it's probably coming to this box here. So that'll just give you some ideas on some game plan on what to do. If you're thinking about buying stocks right now, if you're trying to get into positions, there's certain companies you want to buy. You might, you might wait until you get. Right now like I said, we're pretty high up in here. We might wait until we pull down into this lower trend line and then purchase stocks. I'm still looking for this pattern to happen. So if we pull down and through here, chop a little bit, and then break down to the downside, probably not going to want to be a buyer of stocks. Probably going to be wanting to sit on your hands on the sidelines and waiting to see what happens. So that's it for this week. We're kind of just sitting tight, kind of hanging out, watching to see what's going to happen. But certainly, I would say the markets are elevated right here. You want to wait till they pull back a little bit if you're going to add two positions or you're going to create new positions. So until next week, that's the Middle Class Investor. Again, visit me on YouTube. You can search on Middle Class Investor. You can subscribe to the channel. Or you can follow me on Twitter @InvestorClass. So that little @ sign and then InvestorClass. You can find me on there. On YouTube, you can copy the link, forward it to your friends and family. Again, my goal is just to keep people out of trouble. So if we start seeing big trouble develop, we're gonna sound the alarm. We're gonna ring the bell, so to speak, and help you make a decision about where you might do something and what you might do. And then, but at the end of the day, it's up to you. At the end of the day, it's your money. It's your decision. So I know maybe that some of you that's scary and not comforting, but that's just the reality of the situation. So even if you have your money with a broker, at the end of the day, it's your decision, it's your money. So anyway, y'all, that's the Middle Class Investor this week. Thanks for coming in, and I hope to see you next week. Take care. Bye-bye, everybody.